I did, until they sold their property tax practice. I am not a CPA, no. I am a certified member of the Institute of Property Taxation, which requires a certain amount of years of experience and a quite strenuous test, and that is one of the certifications you can get in my field.
I have one question, and here again, I have no specific knowledge of what's going on in the industry, but just what I've heard in the newspaper and in the news. There's been 2 hotels built in Tulare in the last year and a half, 2 years or whatever. One right after the other, and if I'm not mistaken, I could be, I think they were the same owners. Now, this property being built in '07, completed in '08, is in the same area. And in effect, I could understand the argument that we didn't know what was going to happen to the economy, but we built this hotel when things were doing well, and all of a sudden the market dropped. Why would somebody continue to build 2 hotels in your area? Now, from my knowledge is that there's not a great deal of collapse in the cost of building these things. In other words, labor may decline or materials may decline, but in effect, why would somebody go out and build 2 hotels in this environment?
Well,
And you may not know, but I'm just asking.
I know one of them. I don't know both of them.
Okay.
I'd have to be blind not to see the one when I get off the freeway, the Fairfield end. And I asked the same question. What is that thing doing there?
Right.
What fool would build that? And tried to talk to a number of people. From what I understand, and I am under oath, and what I am saying is hearsay. So
Correct, I understand.
if I get this wrong, I did my best to find out. From what I understood and talked to people, is that hotel had been in process for a number of years. Had issues with, I don't know if it was construction costs or permits or getting it together, but it too had been planned for a number of years. And it didn't get finally to the breaking ground stage till very recently. But it wasn't like someone came in 2010 or 2011 and said, hey, this is an underserved market. I think
Right.
I'm going to put a hotel here. It was my understanding when I talked to various people that they had planned this, worked on it, and for whatever reason, that's the part I'm not...
NASCAR is coming.
NASCAR's coming. It didn't happen when it was supposed to. It sounded like it was supposed to happen pretty close to when our hotel was built. The other one you're discussing, I'm not aware of.
Sure. Okay, well, good presentation. Thank you very much. And we'll now turn to the assessor.
They may have questions of the applicant.
Oh,
I
right
actually,
ahead.
in my presentation, would like to speak to Mrs. Orloff's case, if that's okay with the board.
Sure.
And if I could ask the clerk to pass out the presentation to the board. So there's a copy for Mrs. Orloff as well.
And how does it work in your board? Does the assessor stand up? Can I sit down?
That's a good question. It's completely an informal process.
Okay.
And I have seen other boards somewhat handle this like a court case in the sense that you present your case, assessor presents his case, then you can examine his, he can then cross-examine your cross-examination, and then the board is going to wind up listening to some summaries, and we're going to move on. That's all
In
fluid.
answer to your immediate question, he's going to present from there, so
Right.
So can I sit
I'm not going
there?
to talk to you. You're welcome to sit down.
Sure, go right
That's
ahead.
what I want to know?
Yeah.
Okay.
Okay, Mr. Assessor.
After a review of the data, gentlemen, we've gone through and recommended, as you'll notice on the presentation, a reduction in the assessment to $7.7 million for the subject property. The property was assessed at about 9.3, so we're recommending a reduction of about $1.6 million for the 2011 year for the subject property. In determining that value, we did use all 3 approaches to value. I'd like to go through each one briefly, and then I'd like to discuss some of the points to Mrs. Orloff's case as well. Given that,
I'm sorry, before we start, can I just clarify that this is not the total value of the entire property? This is just the real property?
that is just the real property value,
Okay.
correct?
Because one of the things that the clerk needs to know is the total for everything on when, once the board decides. So we will, that we're gonna add the 680, 550
That is correct.
board comes up with. Okay, thank you.
So, gentlemen, the first approach that we used was the cost approach. And to do so, we used a nationally recognized cost manual, Marshall and Swift. And in that approach, we did recognize some depreciation for the fact that the hotel was constructed in 2008. In reviewing that particular value, we came up with about $8 million by the cost approach. It also caused us to have to use some comparable sales of commercial land in Tulare to add a component on to the cost to come up with that $8 million. But that $8 million is a total value for both the land and improvements. The market approach that we use did utilize 3 comparable sales. All of those sales were within 36 months of the lien date, and the closest of which was 10 months from the actual valuation date. The comparable sales that we used were similar in both the fact they were limited service hotels, they were similar in size, and in year of production. We left the comparable sales unadjusted to take some of the subjectivity out of that approach. After looking at the unadjusted comparables, we chose to go with the lower end of the range and came in at about $7 million on the market approach to value. In utilizing the income approach, we did not go with the discounted cash flow. We went with a simpler direct capitalization. In looking at the subject property, we chose to go with national averages for the income and expenses used to capitalize that by rate, come up with our value. The cap rate that we used as well was born out of both a study of local comparables and national averages to come up with roughly a 9% cap rate. The key issue, as I see it, after going through the income approach to value, we did reconcile all 3 approaches to come up with the $7.7 million. You can see that reconciliation on the last page of our presentation. Page 13, if you'll turn there. You'll notice with the approaches to value, they're all relatively close in range, given the fact that this is a $7 million property. In analyzing it, we felt there was a need to use all 3 approaches because there is some subjectivity in the income approach. You can choose to do one of 2 things: use actual income of the subject property and expenses, or you can use market. In California, Property Tax Rule 8 governs how both the assessor's office and the board has to look at that income when processing it in the income approach to value. Property Tax Rule 8 requires us to look at market, where the subject property and the market coincide with one another. We typically use the subject property's income and expenses to come up with the income approach value. In this particular case, there was a great divide between what was given to us on the profit and loss statement and what averages are for that industry. The subject property uses roughly about an 80% expense to income ratio, and national averages range about 60 to 61%. So we chose to use national averages when determining the average daily rate and the expenses when going through and processing the income stream. The averages that we're getting are from a nationally recognized hotel statistical study that's put out every year. Some credibility in what they study because they break it down into the different markets that are addressed by full service and limited service hotels. So we are using specifically limited service averages to determine the value in that approach. Difficulty with the assertion that the income approach is the only one we should look at. Subjectivity is there. There's less reliability in your conclusion if you don't look at the local comparable sales. I would personally like to point out that 2 of the comparable sales that we used were properties purchased in Clovis, and their comparable sales number 1 and 2 in your packet were purchases by the applicant in the local area during the 2008 to 2010 year. I believe it's page 9 and 10. One of those comparable sales is brick for brick, the exact same hotel that is in Tulare. Rooms, it's built roughly in the same year and has the same branding. We used these sales to demonstrate that the Tulare Hotel, when we look at the value of it, there's a claim by Mrs. Orloff that there's a rapid decrease in value. Her client was investing in the local area up as late as 2010, buying hotels in the Clovis area. The assertion that she makes is relatively hard for me to digest when it comes to the total value. I don't think you'd have horrific market conditions and have the investor still investing in the local area. And I think that's exhibited in her presentation. I don't know if anyone else noticed, but with the gloom and doom scenario we were presented in this packet this morning by her, every single one of the graphs for the subject property shows an increase in revenue year over year. And looking at what she has given us, the income for the property year over year between 10 and 11 increased 15%. With an income producing property where you're valuing it based on the income stream, I would have a hard time claiming what Mrs. Orloff is, which is roughly a 50% reduction in the assessment, during which a time the hotel's revenues grew by 15%. It may be a simplistic argument, but it doesn't make sense to me why an investor would look at it that way. The 2010 value was additionally substantiated by the hotels that we used in this comparable sales analysis. So we used comparable sales 1 and 2 in the 2010 valuation. Mrs. Orloff and her client did not contest it, personally believe, because it was their own purchases in the local area supporting the valuation we wanted to put on the hotel. We came to agreement at roughly I think it was $8.4 million for 2010. After that, they're claiming a 34% reduction in assessment, while their revenues grew 15%. The assertion that the market's collapsing, I don't see additionally in supporting evidence like the capitalization rate. In your packet is a copy of what's called the HOST report. And the HOST report is the Hotel Operating Statistical Study.
Page what?
I believe that's the yellow tab.
The
Yellow
red.
tab
Okay.
presentation. If you'll look at the highlighted overall capitalization rates there, what you'll notice is from a year ago to today, the average capitalization rate went from 10.83 to 9.8, showing improvement in that particular market. I think this goes to further support the fact that during that time period, there may have been a reduction in that market or a depression in that market for some time between 2008 and 2010. We've recognized that at the assessor's office by providing a reduction to $8.4 million in the 2010 year. We're additionally going through and offering another reduction for the 2011 year, even though during that time the revenues increased for the subject property. This is being done specifically because there is a range of value and we're choosing to side on the behalf of the applicant in order to give them the benefit of the doubt. The evidence that she's given here, and I want to touch on it specifically again because Mrs. Orloff throughout her presentation repetitively talked about the fact that it was the actuals that were used in her discounted cash flow. Rule 8 specifically requires both you and I to look at what market is. And I would hope that the board would see that national averages would indicate a reasonable idea of where a hotel should operate. A 20% difference between the subject property and national averages was too much for the assessor's office to look at the actuals. Additionally, there's an issue with the expenses in the hotel that specifically relate to property tax rule 8, and there's something called competent management that needs to be considered here. If you'll turn to the last page of your presentation, this is a document provided to us prior to the last hearing by Mrs. Orloff. The purple tab on the back, if you look at that. In that, you'll notice on the bottom, a little box that says year-end 2011 income information. And while she has the subject property there, right next to it is the exact brick-for-brick hotel that exists in Clovis that her client does own. If you'll notice, what she highlights as a very important part in the determination of value in a hotel, the revenue per available room there, is very similar between those two properties. So it would indicate there specifically that the gross room revenue generated by those two hotels is almost exactly the same. But the net operating income shows a vast difference. It's roughly about a 40% difference in those. Because of the way that RevPAR is calculated, if you back that out, the only thing that can be attributed to is the expenses of that specific hotel. So where you have two hotels that are exactly like in a similar community performing, and you have one have such drastically larger expenses, I think it's a good indication to the board that those actuals should not be used. They're going to result in a relatively low net operating income and then result in a relatively low valuation. Additionally, we took a look at the difference. The Clovis Hampton that they own is performing at national averages. If you take the percentages that the host report points out, at every step, they have met very closely those averages. So her client had a hotel in the area that further supports the use of those national averages because the hotel they own locally was performing at them. The Homewood Inn and Suites was performing roughly similar, although their expenses are a little bit greater because they do provide things like a meal with the proper or the night stay. Having that said, I think that there is real evidence there that you could potentially assume that it was negligent management or it was number shuffling that led to this net operating income being compressed the way that it is. The use of those things then at that becomes something that we need to avoid. Additionally, I would ask the board to consider something more than just the income approach. When you look at that, there are ways, just like this, to have vast differences in the values you come up with, whether it's using actuals. Reconciliation at the end of our look at this particular piece of property, I think, points that out. All three approaches to value come in relatively close to one another, and we've chosen to side at the lower end of that. The assertion that the whole hotel market is in the dumpster and this gloom and doom scenario is not what we're seeing reflected also locally in our own market. I believe it was Mr. Fowler asked about, it was Mr. Zunian that asked about the two hotels being constructed in Tulare. I've included in this packet as well, and it is the green tab before the purple tab, a listing of comparable sales from this region. The cap rates derived by these comparable sales from this local area indicate that we are actually below national averages, which would indicate to me that we have a pocket here in the Central Valley where we do have an underserved area, and why there are companies coming in and building hotels in this quote-unquote gloom and doom scenario. I think that's further supported by the fact that, once again, the revenues for the subject property grew 15% year over year. I found it interesting in Mrs. Orloff's presentation that they did not include the two comparable sales that we did, that were her clients purchased in Fresno. I'm sure there was a mistake in putting those in the presentation, and it wasn't purposeful, but they serve to be a good indicator, because not only are they participants in the market, it is the same participant in the market as the subject property. So I would ask the board that you would consider the $7.7 million valuation that we've recommended, and would open it up to comments from either the board or Mrs. Orloff.
I'll take the prerogative of letting the board ask you questions regarding your presentation first.
Oh, okay.
Henley?
What did you use as a cap rate?
We use 9%.
Did you include property tax in that?
Property tax is 1% of that, so we used an 8%.
So you got 8 and 1. Okay.
Correct.
All right. And you keep acting like Clovis and Tulare are the same market. Is that what you're saying?
If there was a great similarity between the two. The hotel in Clovis additionally, if you look at the location of it, it's actually located behind the Clovis Mall. So it doesn't have the same type of Highway 99 frontage that the subject property has. Appraisers who were informed would look at that and go, it has a superior location, therefore, it might actually have a superior value at the time.
You're saying that you think that an 86-room hotel in Clovis could be equivalent in value to an 86-room hotel in Tulare?
Yes, Mr. McKinley, I'm making that assertion.
Are like incomes for the two communities, sales tax revenues for the two. My feeling is that Clovis is a much more of a go-and-blow-in community than Tulare.
And you would assume that given what you see here with the subject and the comparables. But if you look at the sales that have occurred outside of the Clovis area, and you look at the ones locally here, and we've included one of those in here for that specific reason, there's not much variation between the two communities. They're roughly of equivalent size, and yes, you have a greater metropolitan area paired directly next to the one in Clovis, but you're seeing the same type of income numbers come out of both, which means the overall values between the two are roughly similar.
Now, is the occupancy rate the same?
I believe it was very similar between the two. I didn't check my notes to give you an exact.
Go ahead, I want to gather my thoughts.
I have no questions for you.
Go ahead.
Ms. Orloff, if you'd like to make comments?
May I ask a question?
Yes.
Mr. Kokendorfer.
The real property, we're doing 7.7 million, and then since you're not contesting the personal property, we're gonna be leaving it, I think, at the $600,000 it was for
Right, so what is your total opinion?
not having a calculator, 7.7 million plus 600,000.
0.3, whatever.
Sounds good, Mrs. Grunwald.
50.
I believe it, Ms. Orloff, it is $8,380,550.
How much is that per room?
Let me divide it by 86 here, but I would guess somewhere about $100,000 a room.
Okay. You looked at the comparative sales approach. You discussed the Hampton Inn and Suites in Clovis,
Right.
also owned by the same taxpayer who owns the Hampton Inn and Suites, their town here. Were you aware that, much like the subject property, this Hampton Inn and Suites was a build-to-suit property, was negotiated well before the August 2109 sale date?
I was aware of that.
So, given the way the market changed, knowing that this deal was inked in '08 but closed in '09, does that give you any kind of pause?
Pause in what respect? As in thinking through, like, towards your argument?
Pause, and does it really reflect, say, if you had a hotel that was listed for sale in 2009, open to all buyers, open to you, open to me, what was the highest price it could get, as opposed to a price that was predetermined prior to construction breaking ground? So as you look at the sale, did you think, this really meets fair market value versus other properties that are listed for sale, per se?
Seeing that it coincided with the other comparable sales available, yes, I did agree that it was a fair market sale and that it should be used in this particular instance. The valuation, I would ask you maybe the same question about the income used. Did the increase in revenues year over year give you pause when considering your income approach to value?
Certainly, yes. And as you can see in my first year discounted cash flow, I'm very close to what the total revenues are.
The actuals,
Let me ask you a few more questions. Do you think the hotel in Clovis is better, worse, or the same than the subject?
I think it is similar in every respect, outside of the fact that it has a worse location.
Well, you just stated it's similar economic location, similar, in your presentation, similar income stream,
Similar.
not better.
That is correct.
Yet, when you concluded to the subject property, you concluded to 100,000 per room versus the sales price on this one of 90,000 per room.
You have to remember, I'm rounding numbers. With
I
the
just
math
did
on
too,
it,
190, basically.
But you're rounding up. If you look at the income and divide it by 86, 8.3 million divided by 86 is going to be somewhere less than $100,000. Maybe that's a simplistic approach, but I'm stating that it's very close to what your client paid for this particular property in Clovis. Additionally, they paid 7.7 million for it. We're coming in at a very similar value for the subject property in Tulare due to the similarities in them.
Okay, so what is your proposed value per room? So we don't round.
$96,511. Would you like me to write that down?
No, I'd like to know how you got that.
I believe we just took the
The 7
total
million
assessed
7?
value plus the personal property and divided that by the number of rooms.
What do you have as the personal property?
Excuse me, that's already been stated twice.
Okay.
First, it's in your presentation that you've indicated to the board, and then it was repeated again to you questioning of Mr. Kokendorfer.
All right. The only reason, ma'am, that I asked the question again is because I was coming up with a different number. So perhaps that would be the question that I was trying to determine. And because we had already discussed rounding, and now we were rounding, we weren't rounding, we were close, we were sort of close. So that was my question. My understanding is if you take the proposed 7.7 million and add the personal property assessment to it, you come up to your proposed value of 97,448. Does that sound about right?
I'd have to check the personal property figures.
Okay.
I'm asserting, though, specifically that I'm advocating for a $7.7 million assessment on the real,
Understood,
Real property
understood.
only.
You said that, I got that one.
since we're only addressing that in this case, maybe we should focus in on that.
I certainly would like to focus in on it, but as buyers of hotels buy them, they don't say, I'm going to buy the real property and then I'm going to buy the personal property. They say, I'm going to buy the whole thing. And as you list your sales here, they're listed for the whole thing. You don't break out your price per room either. So that was the only reason I was asking those questions. Let me ask this. Those sales occurred in August of '09, even though consummated in '08. And the Homewood Suites was also consummated earlier.
So if I could stop you, just point out something real quick, since you're making an assumption early. If you'll notice, the price per room we've indicated on each comparable sale is adjusted, which means we extracted the personal property for deriving that. So just to clarify. I would refer you to page 9 at the bottom where it says price per room adjusted.
I was under the impression that the price,
So,
$749. But you think that's adjusted after personal property?
Yes.
Personal property is included or not included in the 7 million?
It is not included.
Not included.
It says that the sale was more than 7 million.
Correct. The actual total sale was something like 11 point some odd million dollars originally. It included some excess land, which we ended up detracting from the sale as well as the personal property in order to come up with that valuation. So
So this was your adjustment then? Your adjustment of the personal property, property and
based
the
on an
excess land.
allocation given to us by your applicant through the preliminary change of ownership report and the evidence provided to the audit appraisal staff.
Okay. Do you feel the market changed at all between the beginning of '09 and January 1st of '11? Do you believe hotel values went up or down?
I personally believe there was health in the market that recovered between the 10 and 11 years. I think our assessment, though, shows that we're giving assent to the fact that there may be an overall reduction in the 2009 to 10 year, and we're giving you the benefit of the doubt in the 10 to 11 year when it comes to the assessment. So specifically to your question, in between the 2008 and 2010, there is definite evidence that the market was on a small decline. That's been reflected in the previous assessments that aren't being discussed here. And the current assessment that we are discussing, we are reflecting a further reduction potentially during which a year your client's revenues grew.
You talked about my client, the taxpayer. Taxpayer is how I'd like to refer to him. Do you believe this client was a competent manager in Clovis?
I do not know the arrangement that your client has with their individual hotels, whether they hire management individually or they manage them themselves. Given the fact that your client is a group of investors pooling capital to buy, I would highly doubt each one of those investors is participating in the day-to-day management of those hotels. Given that, I would think that they are hiring management for each site. And so I would think that looking at the revenues, you can maybe indicate that there may be poor management at the Tulare site, either that or a cooking of the books with the expense numbers increasing or decreasing the net operating income.
I know that my client would highly resent the fact of the cooking of the books statement. This
Can
is
you
a
then,
hotel.
Mrs. Orloff, explain to me specifically why there is such a drastic difference in the net operating income between Clovis and Tulare, even though the RevPAR is exactly the same almost for both hotels?
In order to do that, I'd have to sit out here and go through every single category with you.
Sure, we could sit for the profit and loss statement, but ultimately, the only place, if you look at the calculation for RevPAR, that can be considered is in the expenses, which means they
Understood.
have drastically high expenses. that
Understood,
you
but
have
you're
utilized-
claiming,
that you have utilized in your discounted cash flow. So when it's non-market and you've used it, I think it goes to substantiate our argument that you can't use the actuals in this particular case, nor can the board consider them based on Property Tax Rule 8, where it's specifically spelled out how we, myself and the board, and even you have to look at the income approach to value for this particular property.
let me ask another question. You provided host figures. Those are clearly national figures for hundreds of thousands of hotels throughout the country, is that correct?
That is correct.
Have you done any type of review for hotels and how their operating statistics are here in your local area?
As I informed during the presentation, we did take a look at the comparable sales to see how they related to the host report. And what we found is they were pretty much in sync with the host report. Now, there are variations. Obviously, it's a range and an average. But they were relatively close, more so than the subject property.
So, if I understand you correctly, you're asserting the subject property has bad management or cooking the books on the expense side, and that's why it's not market.
I'm just claiming there's a difference. And
You're
because of
claiming
that,
there's
I
difference.
can no longer utilize the actual income and expense for the approach. And by law, neither can the board consider that then if it's that vastly different. Now, they have to make the judgment call on that, whether they're going to perceive that to be the same that we do. But they're held to task by that rule.
Certainly, we all are. If I didn't feel the expenses were market, I certainly would not have used them myself. But
Do you have anything, Mrs. Orloff, that would support the fact that they are market, showing that they're similar in percentages as every other operating hotel?
I don't have data with me here. I have reviewed PKF and host numbers. In the same sense that you say they're similar, as I look at PKF and host and look at those figures also say that nationally, a hotel that's a limited service hotel has an average occupancy of 70% and an average daily rate of $90. Our subject doesn't have that either. I hesitate to go towards national averages when you clearly have income and expense information of the subject, which is how the subject is performing. It is market performance. But you know,
That's
we
additionally,
could
though-
beat that one up for days.
That's
Let me-
additionally, though, Mrs. Orloff, why we use the other two approaches to value and why they are so important to include in this. And I know you've discounted them in your presentation, but without reconciliation, you're left to the wiles of one approach, which has a great degree of variability. So the trustworthiness of that approach can only be founded when you reconcile with the other two approaches given to us to come up with a valuation for the property.
So your other two approaches are the market approach, which consists of two purchases by the taxpayer and a sale in 2008. Is that correct? Those three sales, those comprise your market approach?
Correct.
Okay. And you don't think a big difference occurred in time where you have to adjust for time?
You know, I would be open if you have additional comparable sales between then and now to consider those. So if you'd be willing to present them to me here, I'd be
I'm
glad
just
to
asking
consider
if you adjusted your sales for time during that.
them. No, I believe I spoke clearly when I said they were unadjusted.
Okay. You list, I have a hard time reading your Exhibit D, but you list for the sale in Clovis a cap rate of or an overall rate of 4.14. How do you get to that?
The data you see here with Exhibit D was provided to us. I'd have to analyze it to ensure that that is specifically done just how you would come to any other cap rate. So given that, not only did I tell the board that we consider these local sales, but we've also considered those national averages given in what was it, the host report that we considered for that. But looking at national averages paired with this local data is what helped us come to that 9%
But
overall cap
I
rate.
understand that. My only question was how you got to that cap rate there, right there. But simple question. How'd you get to the 4.14?
And I'm simply stating that evidence was provided to us, and I don't know specifically how they derived that.
Okay,
Nor would I solely rely my case upon that evidence, given that.
understood. You looked at Exhibit C as well, overall cap rates, and you saw that an average range was from 8 to 12%, is that correct?
That is correct.
And you concluded to 9%, is that correct?
That is correct.
These overall cap rates here listed, do they have property tax expensed?
Because for that particular overall cap rate, I believe that the property tax is not included in that specific rate.
Right, so you would have to add it to your rate, is that
Correct,
correct?
which we did, which is where we came up with the 9%.
Okay, so your rate is basically a 7.75 plus the tax rate, right?
No, my rate is 8% plus the tax rate.
So if the tax rate,
If you could get to the point with where you're going with this, it would be helpful, so we can discuss the other approaches as well.
no, I'm just about done with my questions. I don't want to take
Okay.
too long of your time. The actual tax rate is 1.19, so you're saying you used a rate of 8 plus 1, not 1.19. That's correct?
That is correct. Actually, I believe we included just a general overall 1% rate to include the taxes. We did not use the specific tax rate for that hotel.
All right. I have no further questions.
Okay, well, I have a couple.
Yes.
And I'm going to go first, and then if any of the other panel members want to ask a few. But on on your presentation, page 8, on projected versus actual RevPAR 2010, 2007 to 10, you have actual at $61.31. Is that correct?
You're on page 8?
7.
The bottom
Yes,
category?
6131, right?
Yes.
On the last page of the assessor's presentation, he has 2011 income information, subject property, $61.31.
Right.
And if you go across, for the Clovis property, it's 6515, 7477 for the Homewood Estates in Clovis, correct?
That is correct.
And then on the NOI room rates, it's 4549 for the subject property,
Yes?
and yet 7503 and 7996 for the comparables in Clovis. Why is that NOI so low in Tulare?
My estimate would be, particularly on the Homewood Suites, when you have, with a hotel, you have a certain amount of fixed expenses.
Right?
And when your occupancy and your ADR fall so low, your percentage or your NOI decreases because you still have to cover those fixed expenses. So if you reach a level that is where you're just sustaining
Right.
your help in there, your NOI dips rapidly until you reach a level where you're actually getting more profit from
Right, I
that
understand.
NOI.
But what I'm saying is that Tulare versus Clovis, and one of our other panel members indicated, we're comparing Clovis and Tulare, and that may not be a fair comparison in the sense of what we know about the two markets. But on the other side of the coin, though, the analysis that we have right here shows that the revenue is lower in Tulare, but not that much lower, yet the expenses seem to be much, much higher in Tulare, other than the other two subject properties, and they're pretty much both about the same type of properties.
Without sitting down and going through it, I don't know if you have unions here in Tulare or if you've got higher labor costs here than
Yeah.
you do in Clovis. I couldn't give you an exact answer for that. I would say on the top line, it does appear the properties in Clovis are outperforming the subject property here, just on the top line on money being brought in.
Can I ask
And-
then, Mrs. Ruoff, is that an assertion then that the expenses are excessive for the Tulare or Hampton Inn or above the Clovis at least?
I never said they're excessive. I don't
How else
think
would you
they're
explain that?
excessive.
I mean, Mr. Ozinian's asking a very good question. It's the same thing I posed to you earlier. If you have the RevPAR being so similar between the two, that would
Well,
indicate an
Again,
gross
as
room
I
revenue.
had previously stated, we can go through each of those categories. I'm under oath here.
Sure.
The assessors so disbelieved these income and expense statements when they were originally sent to him that we had to send them certified mail, sworn by a notary under penalty of perjury, that those were the income statements sent directly from Virginia to the assessor, that those are the income statements. The income on each category, it's not a place where you can cook the book. The assessor says, here you have national averages, and you also have this one property in Clovis, which just opened up in 2009, a year and a half later than the subject. And we're trying to look at those expenses without having those in front of me. It would be very difficult for me to make those assertions. The assessor also stated that we're not looking at Rule 8, we're not looking at market. Certainly we're looking at market. We have provided market expenses for the subject. That's
Hold
what the
on,
subject,
Well, if I'm going to stop you, I'm specifically stating we should look at market.
I'm saying, the subject property in and of itself provides market. That's kind of a closing argument, but I'll leave it at that.
Okay.
Let you go there.
Well, here again, I jumped in with the first question. I'll leave it to our panel members to add any other questions that we would like to ask.
Just having many figures in front of me, I'm having a little confusion. What is the income that you're applying the cap rate to?
The income that I'm applying the cap rate to in the reversionary year, after 4 years, is $571,111.
Tim? What's the income that you're applying the cap rate to?
The income we're applying to, Mr. McKinley, if you'll turn back to the income approach to value, which we have on page 12, if you'll notice down there, we're looking at $770,000 for the net income.
No, 548.
No, yes, correct, $770,548.
That's all I have is questions right
I have no further questions.
Any, do either of you would like to have a closing statement, summary?
I just would like to summarize again, and Mrs. Orloff's assertion right here at the end that she's unaware of why there's a vast difference. In a mathematical equation, it becomes very simple when there are only 3 contingencies involved. And because we've eliminated 2 of them, we're down to the one which is expensive. They are excessive compared to other local hotels. Now, the hotel market, while it is regional, we believe that the Central Valley, generally between south of Sacramento down to Bakersfield, is roughly similar. And that's been carried out through the sales that we've seen. I'd like to speak to Mr. McKinley's question earlier. Mr. McKinley, if you look at the comparable sales, the one that we have in Visalia for the La Quinta here actually comes in at a higher per room value than the other two sales in the Clovis area. Now granted, the market conditions changed during that time period, and we didn't do a time adjustment on that. So there could be some reduction in that. But I think the closeness of them does show the similarities between the two markets, even though there are issues with having a 500,000 person city next door versus a 100,000 person city. That some of that may be being off-put by the location of the Clovis hotels versus the Tulare Hotel. I'd have to do an in-depth study, but I think in general, when you look at those sales, it specifically speaks to the fact that those markets are similar. I would just remind the board, we have an obligation to look at market. Mrs. Orloff asserted there that we wanted to kind of do away with it. That is our intent, which is why we brought the market approach into this. We're looking at market with both the income approach to value and with the actual market approach, using comparable sales to help support it. The number of numbers being put forth, Mr. McKinley, I would agree with you, is kind of confounding at times, because we talk all these acronyms and go through and provide you a billion numbers while we're in here. But the key factor is, are we using more than one approach? Are we coming down with what is a rational value based on what we know about market conditions and incorporating that into our assessment? At every step, we've worked to do so. And even through a year where the income did jump 15% year over year for the subject, we've chosen to provide a further reduction because we're giving them the benefit of the doubt. I can't quite give them so large a benefit as the $4-some-odd million that they're asking for, because I believe it to be unrealistic and only based on one approach that has a lot of subjectivity. And I'd ask the board to consider that when looking at this case. One approach to value doesn't necessarily cement the specific point in the market that would have to look at reconciling all three approaches.
Okay. And Ms. Orloff, do you have a closing comment?
Certainly, thank you. We have presented to you the income of the subject property, which clearly mirrors what the market is doing out there. We've also performed an income approach and looked at that and concluded to a net income that is roughly 30% higher 4 years down the road than it is right now. And that is an optimistic approach as to what this hotel would do. We feel it is a reasonable approach and one that should be considered. The assessor would have you look at his case and say, I've performed a cost approach, yet he has not accounted for any type of economic obsolescence, and somehow that value comes in right where his final opinion of value comes. He's performed, or looked at, as it were, a market approach. 2 sales that were clearly not marketed for sale and don't represent fair market value. The 3rd sale occurred in January of 2008 at a time when the market was entirely different. So to stand there and say, we've put together 3 approaches, when the 2, under any type of scrutiny, would clearly have difficulties answering to any normal investor, is difficult to understand. Lastly, he concludes in an income approach. And he looks at the income approach and he says, based on market, we estimate $770,000 in income. A value of net income that the subject property has never seen. They thought they were going to see it, but they have never seen it. And I would strongly disagree with the fact that there is something wrong with the management, that there is something wrong to that extent. The assessor's trying to hang their hat on one sale in Clovis by the subject property's owner and say that that would explain everything away. And also by looking at national averages of hundreds of thousands of hotels and saying, here's the average, that's what we should use. As I said before, a hotel is something that lives and breathes and moves each and every day. Its expenses move with that market. I don't feel, and lastly, the assessor says they used a 9% rate, which includes taxes of 1%, which is an 8%. And if you look at those average rates out there, the lowest is 8%. And I mean no disrespect to your city here, but this is not the premier destination location, and I don't think it is underserved. Or, if anything at this point, it's doing just fine. Hopefully it will get better. But as you look at these 3 approaches, they're really not 3 approaches. You're looking at income approaches that are based on income numbers never seen by the subject property. And a potential buyer may think they could get that, but they're going to look real hard at what's going on. We presented you with sales throughout the state of properties who experienced similar issues during the downturn in the market. I ask that you, like any investor, as of January 1st of 2011, keep in the back of your mind what the market was, who was buying property, and what they were looking at, and really where they were going to get their funding, because money was not flowing. So if you would have had to sell this property in January of 11, I think you would be very hard-pressed to get anywhere near the $8.4 million discussed. I strongly hope that you will see that the value of this property as January 11 is well south of the current assessment and even of the proposed assessment. And I thank you for your time.
Thank you. Thank you both. At this time, I'm going to ask, again, my recommendation is we take this under advisement and review it in closed session and come up with a decision. Then that's what we'll do. Within the next 60 days, you'll be hearing from us.
Great, thank you so much.
Thank you. Sure. Let's take a 5-minute break, and then we'll come back, and I'm sure that we'll go through the rest of the agenda promptly.
Oh, that's right, it's still not, I can't figure out how
Fair
it's-
enough.
Board for Tulare County for October 15th, 2012. Looking at the agenda, we have no other cases that are here to be heard, but we have stipulations for agenda item 11 and 13. Is that correct, Mr. Assessor? Okay. So let's go to agenda item 11 first. And if you've come to an agreement with the applicant, then why don't you go ahead and read in your stipulation?
For application number, or I guess assessee Jack and Charlie's Inc., mailing address 204 East Oak Avenue, Visalia, California, 93291-5091, excuse me. Application number 2010-00789, assessment number 800-236-229-000. The total fixed improvements is $196,600. Personal property at $4,000, coming to a net taxable value of $200,600. And I kind of wanted to point out on that, the original roll value for that assessment was $62,200, and then there was a roll correction for $184,534. That's actually what they're appealing. But we did include the total amount on the roll since everything was opened up on the worksheet, and that was $246,734. So this stipulation's reducing that by $46,134.
Okay. And this applicant is Jack and Charlie's Inc. In Visalia.
Correct.
Okay. Do I hear a motion to accept stipulation?
Chairman, I move we accept the stipulation as presented.
I'll second.
Have a motion and a second. All in favor signify by saying aye. Aye. All opposed, motion carries. Okay, stipulation on agenda item number 13, which is Linda Mendonca, correct?
Correct.
Okay, if you'd like to read in the stipulation.
Assessee is Linda C. Mendonca, Trust, Revocable Trust, mailing address 2785 North Colpian, Tulare, California, 93274. There's 4 stipulations for each year. For the 2006 year, application number 2010-00774, assessment number 148-050-051-000. Land is 357,505, no change. Structure, 382,419. Fixed improvements, 50,311. Personal property, 546,500. And their homeowner's exemption, which is a reduction of $7,000. The net taxable value is $1,329,735. For application number 2010-00775, assessment number 148-050-051-000. Land is $361,442. Structural improvements, $390,067. Fixed improvements, $42,700. Personal property, $504,783. With an exemption of $7,000, brings it to net taxable value of $1,291,992. Application number 2010-00776, assessment number 148-050-051-000. Land, $406,014. Structural improvements, $1,721,123. Fixed improvements, $39,304. Personal property, $494,019. Exemption, $7,000. Net taxable value, $2,653,460. And application number 2010-00777, assessment number 148-050-051-000. Land, $414,500. Structural improvements, $1,996,564. Fixed improvements, $91,064. Personal property, $441,589. Exemptions, $7,000. Net taxable value, $2,936,717.
Okay.
On applications number 2010-00774 through 2010-00777, I move that we accept the stipulation as presented by the assessor.
Have a motion, do we have a second?
I'll second.
We have a motion and a second. All in favor signify by saying aye.
Aye.
All opposed, motion carries. Okay, going down the agenda to items not confirmed, for agenda item 14 is this, I assume that there's a non-appearance, denied for non-appearance. Does the assessor have any information as to where this case is? Okay, then agenda item 15, is that also non-appearance?
That's correct. Mr. Zuni, the remaining portion of the people.
Yeah, I understand. Okay. Daryl Nicholson is a client of mine, so I'm going to recuse myself regarding this case, and I'll hand that over to Mr. McKinley to handle that non-appearance, and I assume that is a non-appearance issue, right?
That is correct.
Yeah. Okay, and then more business forums, agenda item number 17, non-appearance. 18,
That's a withdrawal.
oh, I'm sorry, that is a withdrawal, and 19.
No.
Okay, so I'd like to entertain a motion to deny for non-appearance agenda item 14, 15, 17, and 19.
Mr. Chairman, I move that we deny for non-appearance the applications number 14, 15, 17, and 19.
Okay, do you have a second?
I'll second.
And all in favor signify by saying aye.
Aye.
All opposed? Motion carries. Then I'll hand the gavel over to Mr. McKinley regarding agenda item 16.
I'll entertain a motion to accept item number 16, or deny 16, based on non-appearance.
I'll second that motion. Make a motion that we deny it. Second.
Second? All those in favor signify by saying aye.
Aye.
Okay, I believe the only thing that's left is the withdrawals. And going back to agenda item number 3, 4,